All right. Well, welcome. We'll give it a few minutes here and see if we get anybody else joining. Today, we are going to be talking about everybody's most fun topic, the high interest rates. Interest rates are a funny thing to me because I've never heard somebody yet say, "Hey, do you want to see how low the fees are on my mortgage?" Like nobody talks about that. Everybody gets fixated on the rate.
Yep.
It's like everybody gets, I don't know, it's weird to me because people are like, "Oh, well, I've got a 2.8% interest rate on my loan," and I don't know, people get all, I don't know, they're just weird about it. Like they don't know the date of their, children's birthday, but they know what their interest rate is on their mortgage.
It's almost like a badge of honor where it's like who in the room has the lowest interest rate. And that's kind of
Right.
like yeah.
Yeah. And it's unfortunately, I think that mentality is not very helpful, uh, but today we are going to talk about some ways in which you can actually get a lower interest rate. So we're going to go ahead and get going. We are going to put a link in the comments or in the chat down below. It's going to have a calendar link, and so um, if you are watching this and you're like, "Hey, I want more information," or "I want to see if that will work for my situation," James and I we're going to talk about like a 50,000 foot view in some regard, but there's always going to be exceptions out there. There's always going to be, uh, different cases where different things might not work, or we may say, "Hey, this is a better option for you, and here's why." Everybody's unique, and so if that's you, reach out to James, put a appointment on my calendar, and we would love to sit down with you and actually just have that one-on-one conversation and see how some of these programs may or may not um, work for you. That's the reality of lending in general, and that's the reality of real estate. And we're going to talk about this here in a little bit, but some of the things that we're talking about may or may not apply to specific houses too. And so not only is your specific situation unique, the house situation is also unique. And so we have to take those things into consideration as well. So yeah, feel free, click that link, take advantage of the time that we're given to people so that we can advise you in your specific situation as best as we can. So here's kind of what we're going to do. We're going to go, I'm just going to go through kind of our agenda for tonight. And then we're just going to fly through this and respect everybody's time as best we can. We're going to look at where we currently are with interest rates. And then we're going to look at where we foresee interest rates going in the next year. And we're going to talk a little bit about, what does that mean for us? Why does it matter today where interest rates are going to go tomorrow? We're going to look at some of the tactics that we have and that we have seen to get a lower interest rate. And there's really two main tactics that we've seen, either buy downs or assumptions. And then we're going to look at what are some of the most common ways that we see basically to get sellers to help pay for some of those buy downs if that's the route you go, or assumption too. You can have a seller pay for an assumption in some cases. Um, and then last, we're going to talk about probably the most uncommon way for a buyer to get their interest rate paid down, but it is still a very useful way. It's kind of a hidden secret. And so stay till the end and we'll tell you a little bit more about that. So I kind of want to just turn it over to James. James Clifford, he is a local lender here in the Greeley area. He's with Guild Mortgage, and he's going to talk a little bit about where we are currently with interest rates. And then he's going to transition into talking about where he sees rates going. Keep in mind, like, we don't have a crystal ball. We're just trying to figure out where we think and where some of the industry experts think we're going to go. And so, you know, take it for what it is. James, it's all you.
Yeah. Thanks, Jamie. Yeah, this is a question I get all the time, whether it's people that wanting to refinance or purchase or whatnot. Where are interest rates sitting and where are they going? Um, just a little bit of kind of where interest rates are to start with. And a lot of that really depends on which program you're using, whether it's conventional, jumbo, FHA, VA. Each one of them are at a different point. And when someone asks me roughly where things are at, my website that I typically go to is Mortgage News Daily. That's a pretty common website within the industry to go, what is the average interest rate for these programs across the United States? And so, as of today, as of recording right now, what we've got is a 30-year fixed has an average interest rate of 6.34. Jumbo has an average interest rate of 6.41, so a little bit higher. But then the FHA and VA are a little bit better. So FHA is at 6.06 and the 30-year VA is at 6.08. Again, this is just the average interest rate across companies across the United States, kind of all pulled together for an average. Now, just to let you know, there is a little bit of noise in those numbers. For example, what your specific interest rate will depend on a couple of things, especially in terms of conventional or jumbo, but things like what's your credit score? How much equity do you have in your home? Those things will greatly impact what your interest rate will be. So again, if thinking, oh, conventional 6.35, let's just round it up. That's what I should get. Maybe, maybe not. I've been able to lock in people at a little bit lower rate than that, depending on certain circumstances, 800 credit score, um, 30, 40% equity. So there's a lot of just variableness there. So please be aware of that. And so that's kind of currently where things are going. That is down quite a bit from the peaks, which a lot of interest rates were getting close to that 8%. So we're definitely moving in the right direction. So that's where current rates are sitting today, roughly.
And if you're a total interest rate nerd, you can download the Mortgage Daily. What is it? I forgot now.
Yeah,
The
Mortgage News
Mortgage News
Daily.
Daily app, and you
Yeah,
can, watch it on your phone every day and drive
it's
yourself
very
crazy.
interesting. For sure. And I see realtors post what the average interest rate is all the time on their social media, and that's exactly where they're pulling it from, is from that source. So
I'm
it's a
glad I,
pretty
I'm glad I don't do that.
now the big question is, where are interest rates going? And honestly, that has been a little bit of a frustration over the last, I think, 2 years, because we have all the smart people have been saying for the last 2 years, it's coming down, it's going to be going down. And it's usually that 6 months out or that 12 months out. And yeah, interest rates have come down a bit, but not to the degree that some of the people have said, because there's been new variables that have been thrown in, most recent government shutdown, tariffs, just a economy that's a lot more robust, at least in the numbers go, than what people thought. So a lot of what I'm about to say, please take that in mind, where this is based on the data we have today, which, granted, because of the government shutdown, is a little bit light, but here's where the smart people are saying. And I find it interesting that there is such a broad speculation on this. There's some people like Fannie Mae who are saying that interest rates will be down to about 5.9 as an average by the end of next year. I believe it's the Mortgage Bankers Association that thinks it's only going to be down to 6.4 as far as that goes. In my other research with some of the other kind of AI generated type stuff. They're thinking it could be as low as the mid fives come summertime, and then maybe in the low fives beginning of next year, maybe the end of the beginning of 2027 or the end of 2026. As you can see, there's a broad range of where things are going. Now, a lot of this is going to be driven by what's the economy doing. So, as the job market gets weaker, especially right now, you'll see interest rates go down. If you see inflation stay stubbornly high at the 3%, the 2.7 or higher, then probably rates won't go down. So it depends on what's happening in the economy. So, and one last thing on this, and I'll turn it back over to you, Jamie, is a lot of people are like, why did the Fed just lowered the interest rates? Mortgage rates should go down, right? The answer is not necessarily, because what a lot of people don't realize is mortgage rates are not tied to the Fed rate. The Fed rate is the overnight lending rate, which banks charge each other for borrowing money overnight. And then typically what happens is the mortgage rates are more driven by what the 10-year treasury is. Okay, so if you watch what the 10-year treasury is, that's if it's getting weaker, then the interest rates go one way. If it's getting stronger, then the interest rates go the other way. And typically there's going to be right now there's about a 2%, a little over 2% margin between the Fed and the 10-year treasury. So just watch that. As the Fed does lower the interest rates, it does have a trickle effect across the market. But what you will often see is as the stock market gets weaker, people go to treasuries and bonds for investments. And so there's more demand there. And so rates at that point would get better, if that helps.
Yeah, that makes sense. I think there's always a lot of confusion. People get really fixated on what the Fed does, and it certainly
Yeah.
impacts interest rates. But it's not the full story. I mean, there's a lot that goes into where interest rates are. And a lot of people, they say, where are rates? When they really mean is, what is the 30-year conventional rate? That's what they're interested in, because there is a lot of
Correct.
variables and stuff that, you were talking about, which I think that's good to know. And so I think really the big question for a lot of people is, okay, well, if rates are going to go down, if we see this trickle effect that's going on, and I do think we're seeing a trend,
Mm-hmm.
um, does that mean we should wait? Or what does that mean for us? And I think there's a lot of things to consider, because a lot of people I talk to, they're like, well, that means I just need to wait till interest rates go down, right? And you're like, well, there may be some unintended consequences for
Mm-hmm.
that waiting. And right now, over the last 3 years, really, we've seen a little bit of a backlog of home buyers, because people have been waiting for interest rates to go back down.
Mm-hmm.
And some people are waiting for interest rates to go back down to 3%. Now they're going to be waiting for a very long time. But
And
most people I don't think are waiting that long. Go ahead,
and
though.
honestly, Jamie, we don't want to have 3% interest rates from an economic standpoint. The thing that created the environment for 3% interest rates was 2008, was
Yeah.
COVID. Those economic strains that, a lot of people were without work. We don't necessarily want that again. So, and that's what it's going to take to get those twos and threes again.
Yep. Yeah, 100%. And so ideally, we can get interest rates down into that mid five range. I think that's
Mm-hmm.
a healthy place for us to be. Um, and once we get there, or even close to there, kind of our prediction and what we've seen over the last few years is, as soon as rates go down, our phones start ringing, buyers start coming out of the woodwork.
Yep.
And we haven't even crossed into the range yet. We're still in 6 territory for the most part. And
Hmm.
so what that tells me is once we get into the fives, especially into the mid fives, we're going to see demand pick up, um, potentially rivaling what we saw during COVID during 3% territory,
Yeah.
just because we have such a backlog of buyers. And not just backlog of buyers, we also have a lot of sellers that are on the fence as well. They also need to buy and they're not willing to trade in the mortgage they have now for a new mortgage because it's too expensive.
Hmm.
Once that number goes down a little bit to where they're like, you know what, I didn't want the 3-car garage, but hey, if I have to pay a couple $100 more a month, I'm okay with that because I really want the 3-car garage now. That's the kind of demand we're going to start seeing. And so we're going to see a very hot real estate market. And whenever we see a very hot real estate market, we see home values skyrocket. And I think we're going to
Hmm.
see that again. My prediction is probably next spring, we're going to see a very hot real estate market. Now, it's probably not next spring's probably not going to be the mid fives. We're probably not going to see the same thing we saw during COVID, but it's still going to be a very hot real estate market. And so that's kind of why we're doing this today, because we actually think now is a great opportunity for buyers to get into the market when prices are still steady. And some properties have been sitting on the market. And so there's some things we can leverage to actually help you get a lower interest rate today. And then when the frenzies start next spring, you can sit on your back patio sipping coffee and thinking, I already got a home. I'm set. I'm just going to wait for these rates to keep going down and we'll refinance.
Hmm.
That's really the goal. And so that's why for us, um, it really does matter what we think rates are going to be doing in the future because it's going to drive that buyer demand, and more buyer demand that's out there, the higher prices are going to go. I was actually talking to a guy a few days ago. He's an investor here in Greeley, and he was talking about the housing crash, which I usually just roll my eyes and I'm like, oh yes, everybody's waiting for the housing market to crash. But we just have so much demand. Honestly, it's not going to. And he made the comment, he goes, I think we had it. I think the housing market crashed the last 2 years. And I was like, really? What are you talking about? He goes, we haven't seen hardly any appreciation. And we would have if the housing market had continued to go its natural course. And so he's like, I actually think that the lack of appreciation was, in a sense, a housing market crash. And I was like, well, I'm not sure I necessarily agree with that, but it's an interesting concept. And well, I'm not sure he's necessarily wrong either. So
Hmm.
yeah, I mean, I think right now we're going to see the prices continue to go up. We saw them dip just a little bit this year, because I think, buyers are tired of dealing with these higher interest rates. But then as soon as we saw interest rates just really last month or even couple months, start to trickle down to a point where they're a little bit more sustainable, we've seen buyer demand get out there.
Yeah.
All right, so let's get into some of the meat and potatoes of this. Let's talk about some of the tactics that we have for actually getting a lower interest rate today. Because sometimes people, they see that 30-year fixed rate, on their Mortgage News Daily app, like on my phone, and they're like, well, this is the rate. And it's like, well, that's the base rate, but there's ways that we can actually get a lower rate. And really, the two big ways, one is going to be a buy down, and James is going to talk about that here in a second. And then the second one is going to be a loan assumption, and I'll talk about that after James gets done. So take it away, James. Tell us about buy downs.
Yes, buy downs, such a great tool. It's not right for everyone, but it is a fantastic tool to help, match up what your needs are with what your budget needs are or what you need for qualifying. So simply what we've got really two different types of buy downs. One is a permanent buy down and one is a temporary buy down. And honestly, each one of those has a different benefit for you, and I'll kind of walk you through both. What a permanent buy down is, in essence, you're putting some money up front at closing to buy a lower interest rate. And there's a certain calculations that go down. You put so much money, you can get an eighth off the interest rate, and then you can kind of keep going down as far as wherever it makes sense for you. For example, if someone wants to get a 4.5% interest rate, there is a way you can buy down the rate to get there. However, it's going to be extremely expensive. And honestly, I think it's not as good of a decision. However, if you come in with a base rate of, let's just say, 6.25, and you put a little bit of money down, and there's ways we can do that, and we'll talk about that here in a bit, and get a 6% interest rate or a 5.99, you could save, depending on your loan size, a little bit of money each month. And that might make sense for people. So basically what you're doing is you're buying down that interest rate and spreading the benefit across 30 years. Now with a temporary buy down, we're doing some of the similar stuff. We're putting some money up front, but instead of spreading it out over the 30 years, we're front loading that for the benefit to be in the first year, 2, or 3. And there's variations there. Probably the most common interest rate buy down that I've seen is a 2-1 buy down. And you may have heard that in the market here, but simply what that means is for the first year, your interest rate will be 2% lower than what your note rate is. Year 2, it'll be 1% lower than the note rate. And then year 3, for the rest of the 30 years, it will be at what that note rate is. Okay. So for example, if you come in and your note rate, the base rate is 6.25, for an example, then your first year's interest rate will be 4.25. The next year will be 5.25. And then year 3, 4 will be that 6.25. And to be clear, this is not an ARM. So we know exactly what the rates are. Just view this as a temporary discount to help you save money. Okay. Now, the trick with how you are able to get those buy downs, a permanent buy down, you can pay for that with your own money. The lender can contribute. Also you can use seller concessions, or the seller can contribute to that permanent buy down. However, with a temporary buy down, some programs will allow you, like conventional now has opened it up. So for the most part, you can contribute to that as the buyer, but mostly that's going to be funded by either seller concessions or lender paid buy down of some sort. Okay. So that is 2 different ways that we can do that. And I think some people use the permanent buy down either to help them afford the home that they want from a qualifying standpoint, or they just like the idea of that consistent savings over that 30 years. The people that tend to go with the temporary buy down are kind of banking on the fact that interest rates will continue to come down over time, and we'll just have that savings up front. And then hopefully here in a year or 2, then we'll be able to refinance into that lower rate, and therefore kind of almost locking in that savings, for lack of a better description there. So 2 different strategies. And by the way, you can mix the 2 if you want to, and a lot of people don't realize that. So for example, if you have your base rate at 6.25 and you do a permanent buy down to that 6%, and then you put on top of that a temporary buy down, again, 2-1 buy down, for example, then the first year is going to be 4%. The next year is going to be 5%, and then 6% for the rest of the 30 years. So different ways of mixing and matching depending on what resources that we would have to work with.
Yeah, and I think, you kind of already said this, but when you go to the temporary rate buy down strategy, really the strategy is predicated on interest rates going down and then refinancing in 2 or 3 years. And that's why we would do like a 2-year buy down or a 3-year buy down, or even a 1-year buy down if you think rates are going to go down significantly enough in that time. Really that's the strategy. if that's what you're planning on doing, that's the best way to get in there and save more monthly payment today with the idea of refinancing down the road.
And another reason somebody would use a temporary buy down is if they're expecting a big promotion at work where their income is going to jump. So you get the temporary savings before, like, say you're finishing your master's degree, you know that as soon as you're done here in 6 months, you'll get that promotion, a big pay bump. Sometimes people use that as a budget management tool as well, which is a very smart way of doing that.
Yeah, no, that's a good point too. All right. So the other way, the other tactic that we are seeing people, I'm not seeing a lot of people, but I am seeing some people, and it has to be the right situation, is using a loan assumption. Now, what that is there are certain government backed loans that can be assumed. In other words, if James has a house with a government backed loan, I want to buy James's house, but I don't want to pay the current rates, and James has a lower rate on his mortgage, I can take over James's mortgage and start making the same payments that James was making. Now, the stars really have to align in order for this to work. You have to be flexible on time, both the seller and the buyer, because they do take a lot of time to go through the full assumption. You're not working with a traditional lender, a new loan at this point. You're working with the loan servicer of the existing mortgage. And so you have to have time and be patient with them to go through that process. There are companies that help guide you through that process, which I think is a good option, but they do usually charge about a percent, right? So if you're buying a house at 500,000 or a loan at 500,000 at least, they're going to charge you, 5 grand to help you get that loan. And so it is a little bit more expensive. And so time is a big thing for people. That's usually the piece that kills it. A lot of the times sellers, they need to sell quick and they can't, mess around for 30 to, or it'll be more than 30, but 60 to 90 days. Um, a lot of times they can't do that. And so they're not in a good situation for an assumption. And a lot of times buyers, they need to get something bought. They can't mess around for that period of time either. And so time is a big one. The other big one is cash. Because if James has a house and let's say his house is worth $600,000, but he only owes his loan is only for $300,000, I'm only going to assume his loan for $300,000, but he's not going to sell me his house for $300,000. He wants to sell his house for $600,000. And so if that's the case, I have to come to the table with $300,000. Now, there's some companies that can do like a secondary loan for that. Um, Honestly, when I've run the numbers with other people, usually if there's a secondary loan, it basically eliminates all your savings unless that the interest rate is just like 2% and super, super low, but it usually just eats that up. And so if you have to bring a second loan, if it's substantial at all, this may not be a very good option. You may not save as much money as you think. But if you have, let's say you have to sell a house and you're going to come to the table with 300,000 of that money from your previous house, then maybe a loan assumption might be a good option because then you've got the cash to make up that differential, that delta between what the loan amount is and what the sales price is. And you also have to figure in, right? There is going to be cash to close. You're not doing a new loan like you would if you were calling James and say, hey, James, I need to buy a house, but there's still going to be costs and there's going to be some costs associated. If it's a VA, there's some special costs associated with that. If FHA, I think there is as well. And so there's always going to be some costs. Plus, if you use a third party to help you manage it, there's going to be those costs as well. And so it's going to cost you more in this case, more than 300,000. And so you have to have the cash to do it. You have to have the time to do it. But if the stars align and you find a seller in a house that you really like in a situation that's going to work and you've got the cash, it can be a really, really good option. And there's a few websites out there that most of them are companies that specialize in loan assumptions, but they're advertising what the interest rate is on certain loans. Something that I found out through the process is they're just guessing, honestly. They look at when that loan was originated and then they look at what the standard interest rate was back then, and they say, yeah, this probably is a 4.5% loan. Usually they don't actually know. And once you have identified a property you want to look at, that's when we start conversations with the listing agent. And that's really when we start to find out the meat and potatoes of what that loan looks like. What's the balance? What's the interest rate? What's the payment looks like? All the rest. And so that's kind of like you can find the properties and start the investigation on those websites, but then we really need to do some due diligence after the fact there. One of the cool things about this, I think, is anybody or almost anybody, I think, can assume a VA loan. You actually don't have to be a veteran to assume a VA loan, which is pretty cool. On the seller side, they also have to understand that the seller is going to lose some of their VA benefit because now that VA loan isn't going away. But in some situations, I had one last summer where the seller didn't need that VA benefit, and so they were fine with it being assumed, and so it would have been a pretty good situation. And so that's kind of a uniqueness to loan assumptions. Um, Full disclosure on loan assumptions, they are just very difficult. They take time. You got to be patient. Most of them don't work because again the stars just have to align with everything making sense. And then sometimes if you're in it and you're bringing a lot of extra cash and all the rest and you're in a loan for 5%, it might not make sense at that point to do the loan assumption. It might make more sense to actually do a loan buy down. But you can certainly weigh those costs, and it is a pretty good option, especially if you're getting into a loan that's 3% or lower. Like those tend to be pretty sweet deals for people. So that's loan assumptions. And I did forget to say too at the beginning, if you do have questions along the way, just put those down in the chat and we will address those at the very end. All right, so let's keep going. We're almost there. We've 30 minutes in, hopefully we won't take the full hour. But one of the things that a lot of buyers are struggling with and have forever is having enough cash for a down payment. And now we're talking about buying the interest rate down and all the rest. And it's like, man, that's just more cash. That's just more cash. How are buyers ever going to afford to use some of these tactics that we're talking about? Well, there's something that we are seeing a ton right now in the market. I am seeing, in fact, I would say the majority of contracts that I see on the sell side or buy side, probably 90% of them right now have this tactic, and it's we are asking for seller concessions. And what is seller concessions? It gets kind of confusing for people, especially on the buy side, because a lot of times we go in and we offer full price for a house and then we ask for seller concessions. And sometimes the buyers are like, well, wait a second, we're offering full price. Why don't they take it? Well, seller concessions essentially is the seller is giving the buyer money back at closing. And so if we were buying a house for $500,000 and we were asking for $10,000 in seller concessions, essentially we're buying that house for 490,000. And so a lot of my buyers are like, well, why don't we just say 490 and not do the seller concessions? It's because we can take those seller concessions and we can use those for some closing costs. And some of those closing costs might include some of these rate buy downs. And that's really a powerful thing because now we're buying the house and we're not using our own cash to get that rate locked down. We're actually using the seller's cash to get that rate, bought down a little bit, whether it's temporary or a full one as well. So you have anything to add to that, James?
Yeah, I think buyers and sellers have to look at what is the net, not the gross, but what's the net that they're going to be getting. And I would agree. There's probably, yeah, I would say 80, 90% of deals right now, especially ones that are not for cash, have some sort of seller concessions And this is a very, very common strategy. And as a lender, being able to get seller concessions, I can use those in so many different areas to meet people's unique financial needs. Whether it's I don't have as much cash for closing, I need a little help, or I want a lower payment, a mixture of all that. There's a lot of things that we can do.
And ultimately, hopefully, part of the goal of the seller concessions is it lowers how much cash the buyer may need to bring to close,
Mm-hmm.
um, which is good because there are some situations too where the buyer may have the cash, but they need to do some repairs on the house, or there's some, maybe they need to buy furniture for the house or something. They need more cash after the closing. And so sometimes we can go in and we can get houses bought with seller concessions to not eliminate, but at least reduce some of the cash the buyer has to bring. Now, one
Yeah.
of the things when it comes to seller concessions too, because every situation's unique, every property
Mm-hmm.
is also unique. And that's one thing we have to understand when it comes to seller concessions. There are some properties that we just can't get seller concessions. Like it's just
Yeah.
not right. It's just not going to work. And those properties tend to be properties that just hit the market. They're super popular. Lots of people are looking at it, and it may go above asking. We're still seeing those properties out there. That's not all of them, but that is some of them. That's one type of property that's hard to get concessions. The other one is, sometimes you just have a multiple offer situation, um, and you have to forego your concessions in order to get your offer accepted. Sometimes you can't get them on those. And sometimes honestly, you just deal with sellers that they're either stubborn or they have to get a certain amount and they can't go
Mhm.
below that. And so sometimes we can't get seller concessions. Now, if we think the property is actually maybe worth a little bit more than what we have, or what they have listed for, we can say, well, let's raise the price a little bit to make up for those concessions. So if you're, buying that $500,000 house, you raise it to 510, and then you ask for 10,000 concessions. It still uh, will reduce the amount of money that you have to bring to closing, which is great. Your payment might be a little bit higher, but again, it's probably insignificantly higher. Again, that's where you would talk to your lender and you would say, all right, lender, what would my payment look like if we did this? And so those are some tactics that we use. But if you have a property, and we do see a lot of these, let's say it's sat on the market for 2 or 3 months, and we're like, man, it's sat on the market for a couple months. All right. Well, we're going to go in and we want seller concessions. Sometimes those you can ask for a lower price, you can ask for a bunch of concessions, and you can really, negotiate on a property like that and really craft the offer to be as advantageous to you as you possibly can. Now, I will say, and James, you can chime in here, there are some limits to how much concessions that we can get depending on the loan type.
Correct. Yeah. And let me go through that. And there's also a limit on what you can use it for. So with a FHA loan, you can get up to 6% of the purchase price. So that's pretty generous as far as that goes. On a VA loan, it is 4% of the purchase price. On a conventional loan, a lot of it depends on how much you bring down. And um, so if it's less than 10%, then it's 3% that you can get. If it's below 25% that you have down, then there's 6%. But if you have more than 25, you can actually get up to 9%, if I remember correctly, of the purchase price for seller concessions. I'm thinking in the market, and Jamie, you can uh, corroborate this. I would say typically the most we're probably going to get might be 4% of the purchase price. If it's been sitting for a very long time, we might get close to that 6%, but those are usually one-offs on and somebody that's very, very motivated to sell. So
Yeah. Yeah,
yeah.
sometimes it's hard to get that much, but again,
Mhm.
it depends on the situation, depends on the house, and I mean,
Agreed.
every seller is different too, and sometimes I get surprised by those.
Well, and also too, seller concessions can only be used for certain things. It cannot be used for any down payment stuff. Okay. A lot of people kind of misunderstand that. So down payment has to be covered either by cash from you as the buyer or some sort of down payment assistance program. Okay, so that's what that is. Now, seller concessions can be used to cover any and up to all closing costs. So whether it's lender fees, whether it's your upfront taxes and insurance, whether it's your appraisal, whether it's any of that type of stuff, any costs associated with closing the loan, seller concessions can cover that. And then, of course, back to our topic here, they can be used to buy down the interest rate, which is part of the costs of doing the loan. And so those what it can be used for, and we can mix and match all that stuff as well. So definite huge benefits there.
Yeah, for sure. For sure. All right. So now you've kind of seen how you can get a seller to help pay for your closing costs or some of your closing costs, and how a seller can help you buy a rate down. Now we're going to move to our last topic, and we're going to talk a little bit about something that not every real estate agent will do and not every lender will do. And that's actually, we actually can contribute to helping you with your closing costs and helping you buy interest rates down. One of the things that we do as a real estate company at P23 Realty is we give our buyers 10% of our commission back at closing. And so that money, and it depends on obviously the purchase price and how much the seller is paying in commission, because 99% of the time the seller is the one going to be paying that. And whatever we get paid, we're going to give that back to you in the form of a credit at closing. And then that can be used for some of the rate buy down stuff and closing costs and all the rest as well. And I'll let James talk a little bit about some of the things that he's been willing to do down the road.
Yes, typically what we're able to do here is I'm able to get what's called a subsidy for or a lender credit, kind of interchangeable words there. And to be able to do that, typically what I can do is 50 basis points of the loan amount. See, I have to go by the loan amount, not the purchase price, because that's kind of where what we look at. But 50 basis points for you to be able to use as a buyer in any which way you want. There are some limitations on that, but for the most part, I'm able to do that on pretty much any loan. Some of the down payment assistance programs I can't, but getting that assistance, I think, so oftentimes is offsets for that. So that's a lot of what we can do. So, in other words, if we get seller concessions, we get Jamie's credit, we get my credit, we can really stack all those different things for your benefit. And we've been able to do some pretty creative stuff for our past clients.
Yeah, and especially when interest rates are high and everybody's waiting for them to come down, when you stack all these benefits, sometimes you can get a pretty attractive interest rate, and and more importantly, you're getting a house at a very attractive price. Now,
Yes.
everybody would like things lower. I would like to buy houses lower. I would like interest rates to be lower, but the reality is we live in the real world, and so we have to adapt for this real world. And this real world, interest rates are still higher than we want. And these are just some tactics for you to use to hopefully get an interest rate that's affordable for you so that you can find a house that you enjoy, that's going to be comfortable, and that hopefully will be a house that you're in for a long period of your life, that you can you know, either get the loan paid off and just give it to your grandkids, or build a lot of equity. That way, when you do make a move, let's say you buy another house down the road, you sell this one, you buy another one, you have all this equity now that can help you make the next home even more affordable. Well, I appreciate everybody. I appreciate all the conversations. Doesn't look like we have any questions in the chat, which means we just did a fantastic job explaining all of this, James.
Yep.
Uh, do you have any closing thoughts before we conclude?
I think just one, everybody's financial situation and options are different. So exploring this, I think is a great smart choice. Um, don't wait too long because I think once interest rates hit kind of at the mid fives, I agree with you, Jamie. We're going to see a lot more demand, and that will cause I think the seller concessions will become a thing in the past, and we won't have that option for rate buy downs. And also just what we have to offer to get into a home will increase as well. So now is a golden opportunity. We have the options to be creative, so it might be worth a conversation.
Yeah. Well, and I talked a lot about like things going back to what it was like in COVID, but maybe I shouldn't make the assumption that people actually know what things were like during COVID. I mean, when I was working with buyers during COVID, especially buyers that needed down payment assistance, they didn't have a lot of cash. Like they were hard buyers to get offers accepted. And I had one buyer that we had written probably 15 or 16 offers before we finally got one accepted. It was tough. And a lot of times those buyers, they're having to put additional money um on the table. A lot of times we were having to go, if the house was listed at 500, we'd have to offer 510 or 520. There's always the horror stories of like 50,000 over asking or 100,000 over asking. I have never written an offer 50,000 over asking. I wrote a $40,000 over asking offer once, but that was against my advice. My buyers were getting desperate and they really, really wanted the house and they didn't even get that house. And so, but that being said, there was a lot of that. We did a lot of price gaps or appraisal gaps where they would just the buyers were putting money on top of what the appraisal came in. And there's a lot of things. I won't go into all the details of this, but there was a lot of buyers that were trying to waive inspection and doing everything they could. It was such a competitive environment. And as a real estate agent, I'll be honest, I did not like that time period. It was really discouraging to buyers. It was really hard to get good buyers into houses. You had to move so quick. A lot of times we'd go look at a house and I'm like, I would need an answer today, if not within the next few minutes, because we have to write an offer on these things. And that's the kind of environment that I do think eventually we're going to go back because we have so much demand. And
Yeah.
if you're a buyer today and you're thinking, well, maybe I'm going to wait till that environment comes back, it's not a fun place to be. And I'm
Mhm.
just telling you from my experience, I don't wish that on anybody. It's very stressful and we end up paying more than we should for a house. I have a house on the market right now that they bought it um 2 years ago. And for whatever reason, I wasn't their agent when they bought it. Their agent had them pay 30,000 over asking, and it didn't even appraise 2 years ago. Now we have it on the market for 10,000 below what they paid for it 2 years ago. And add all the fees and stuff. I mean, they're probably gonna lose 30 or $40,000 on this house. But they got to sell. They're moving out of state, and so it's a unfortunate situation. But they got in the situation because they were forced to pay over asking and to get in a competitive situation. And I
Mhm.
feel bad for them, but I don't want to see people there. And so that's why we're encouraging our buyers to get into the market today um, before we see that market come back. So yeah, and again, we've got that link down in the description. James has his email down there or in the chat. So click that, sign up for a consultation, send James an email, ask him any questions that you have. We're a resource for you guys. We want to make sure that we're helping you guys navigate this process. And both James and I think I can speak for James on this. We want to see our buyers in good homes, in good mortgages that set them up really, really well for the future. We don't want to see people in a situation that is going to be hard. And so that's where we're trying to guide people uh, as best as we can. All right. James, any final thoughts? Or you already had your final thought?
I
So,
already have my final thoughts, so definitely don't hesitate to reach out to us to ask these questions for sure.
all right. Well, we're going to give everybody 10 minutes back on their day. Have a great evening, and we will talk to you guys later.